Hey everybody, thanks for joining us here. We are live on this Sunday. I want to thank everybody for being here. Love doing these live streams just because it's a chance to get that interaction and kind of a little bit more face to face with everyone there in the community, answer some of your questions, and I always have a great time doing it. So going to get started this week, and really important show for you because the stock market just had its best 6 months in years. And it's actually its best June since 1938. Okay, after the big sell-off we had in May, then market roared back to posting all-time highs pretty much every day, it seems. So where do we go from here? I've had a lot of questions from everyone about what's the second half look like. So I thought I would just share kind of my second half investing strategy. And the idea here isn't going to be to tell you what to buy and what to sell and really how to invest, but I'm going to show you some of the tools that I use to follow the market and kind of stay on top of this. So we're going to get started. If you're seeing me all right, and if you're there, just go ahead and say hi in the chat window, and we will get started. I just want to make sure that everything is going here. All right, we got a few people in there. Nasu, I hope I'm saying that right. Hello. Braun 306. All right, so we are going to get started because, like I said, I'm excited about kind of sharing these tools and these resources. They're all free, free tools, free resources. I'm not going to be promoting anything on this, on this live stream, but it's just some really important economic data, economic sites, stock market investing sites that I want to share with you to really see kind of the picture of where the stock market is at. See a lot of people joining in. Charlie, William, NYC Trader. Hey, how you doing? Greg, how are you? Good to see you there. So we are going to get started. We're going to do kind of the same layout we usually do. We do a few community shout outs. Love answering your comments every week and the comments that we get in the videos. Some great ideas, great suggestions, and some great questions. We'll highlight a few of the videos last week and then this week, and then we're going to get into that topic this week. Where's the stock market going for the rest of the year? Which sectors and stocks are still a good value, and what can you do to grow your dough? And maybe even more importantly, protect your dough after this 10-year bull market. And then, of course, we'll get into that question and answer period, which is always a lot of fun. So first, I want to jump right into those comments. And again, the comments are really kind of a lot of the reason why I do this YouTube channel, because I love interacting and talking back and forth with all of you. So anytime you have a comment on a video, good or bad, let me know. Let me know which videos you want to see. Let me know which videos you don't like, which videos you like, and we kind of go from there. So first, I want to highlight Brad's comment here, and this was kind of the impetus to this week's subject, right? Brad says, I love your advice, but I'm afraid of a major stock market correction. Should I wait a while? And Alex's response here was really good as well. He's said he's been worrying about a stock market correction for 5 years, and it hasn't happened. You can't pick the top. You're probably not going to pick the bottom. So I never tell people to completely just wait out the stock market. I think there's a lot of things you can do. You don't necessarily have to keep trading to or keep investing all of your money in stocks if you're afraid. First, I would say to Brad right here, the fact that he says, I'm afraid of a major market correction. I mean, that kind of tips me off that his risk tolerance maybe is a little bit lower than some other investors, right? And a lot of investors, they don't look at this risk tolerance idea when they're investing, right? And it's so important because it's really going to help you make those better investing decisions. Okay, so your risk tolerance is just kind of the general level of stress you feel when your portfolio value or when your wealth does swing up and down wildly with the stock market. Okay, it's your ability and your willingness to tolerate risk. Okay, your ability is mainly going to be like your age. If you're young enough to withstand a lot of those market crashes and still bounce back. The size of your portfolio relative to kind of your long-term goals and some of those things, your income stability, that kind of thing. Your willingness is much more that emotional and psychological idea. So if you really get stressed out when your portfolio falls in value, then that's going to cause you a lot of emotional stress, and you're going to be more likely to make a lot of those bad investing decisions. Okay, research by Dalbar puts it out every year on the average investor returns, right? And it's pretty much the same every year they do it, because what you find is the average investor underperforms the stock market wildly, broadly. I think the last 10 years, average investor has made upwards of around 4% return annually, okay? And that's against a market that's done 10% a year. And it's because, investors jump in and out of stocks. They jump into a hot stock and then they get scared a little bit when it comes down, and they jump right back out. So they end up, buying high and selling low, which obviously is just the opposite of what you should do. So very important to understand your risk tolerance, and understand your long-term goals there. So if you are one of these people, one of these investors, and nothing wrong with, having a little bit lower risk tolerance, then, a stock market crash is going to affect you emotionally, then there's nothing wrong with putting a little bit more in bonds, a little bit more in cash, and just waiting for a better time to buy, right? Because 10 years into a stock market bull, everybody likes to think that this time is different and there's never going to be a crash, there's never going to be a correction, but there will be, okay? You only have to look as far back as December to know that stocks are going to come down, okay? And we'll talk about a few things today to kind of point to that. But if like I said, if you want to, if you have a little bit lower risk tolerance, be a little bit more in bonds, a little bit more in cash. Even if you have a higher tolerance for risk, long-term investor, I myself, I have about 14% in cash right now, as well as a pretty large bond portfolio. Okay, so I'm pulling back in stocks as we go into the second half as well, and we'll get into that. But Brad, thank you for the question there. Now let's go to our second comment. Okay, second comment here is from Snafu2346. I love that. Great help, not just suggesting stocks, but also teaching the industry as a whole. And besides just a little bit of flattery here in the comment, which always feels good. I wanted to point this out because this is a lot of the reason why my videos tend to be a little bit longer than what you'll see on YouTube a lot, and it's because I don't want to just do a bullet list of stocks for you to buy. Okay, I get a lot of comments sometimes that, hey, just get to the point, get to the stocks to buy. Skip over all the introductory stuff, and that's not really what I want to do. That's not what I'm here for. Okay, I want to show you, like I'm going to do today, I want to show you the tools and the resources for you to make your own investing decisions and make better decisions, not just, okay, right now, 7/7/2019, invest in these 3 stocks, because that's not going to help you. Okay, eventually I'll retire, or maybe not, and I won't be around to tell you what to do anymore. Maybe you want a little bit more information, a little bit more power there to pick your own stuff. So that's why my usually through each video I try to start off with the why and the how of a lot of stuff instead of just going into those stock picks. But I appreciate it. I appreciate that comment there, Snafu. And so now let's get into, I want to talk a little bit, just real quick, about last week's videos, next week's videos, and then we're going to get right into that second half strategy. Some of the things I'm looking for, and some of the some of the things that you can use to make your better investing decisions. Last week we had our portfolio update, and it is constantly amazes me how well this this dividend stock portfolio is doing this year. 6 months into the year, it's at 25% return for the portfolio. That's about 7.5% above the stock market return. And actually, the video was one of the most popular ever. It's just over 10,000 views just in the first 2 days. So really popular video. I've actually linked that into the description below to this, or not this description, but into the comments below in this video. So check that out if you haven't been following our dividend stock portfolio so far this year. Got 6 months left to do in that, and there's a lot of the stocks in there I think are really going to do well. I actually put a comment out in that video yesterday in Friday's video that kind of thinking about 2020 and what kind of themes we should do. So always looking for ideas on themes. This year we did the dividend stock portfolio. Next year I want to do some other ideas, maybe do some community portfolios, let you pick portfolios and kind of track those throughout the year, have a little contest to see whose portfolio does well. So I'm looking for different investing sites that'll let us do some community portfolios, but then some themes as well. Either maybe growth stocks, value stocks, maybe do another dividend portfolio, things like that. So like I said, let me know in comments, what kind of portfolios you want to see, what kind of investing themes you want to see for that 2020 stock market challenge. Next week videos, we're gonna start in on some blogging series on Friday, and I know most of you are here to see about investing videos, and you like talking about investing. Love talking about investing myself. That's where I come from. That's my profession as an analyst. But I gotta tell you, it's not just about investing. If you're looking to build your wealth, if you're looking to really grow your dough and reach that financial independence, it can't just be investing. Okay, you've got to be thinking about creating your own assets, whether they be online assets, whether they be a traditional offline business. Something that is actually going to acquire those assets, right? Not just investing in someone else's assets. So, blogging has changed my life. I love talking about it and how it's helped my income grow, developing those blogging assets, and then this YouTube channel as well, and then just different side hustles. Next week, actually on Wednesday, I'm leaving for Los Angeles, going to VidCon this year. So there won't be a live stream next Sunday. But we'll be back the next week. But we'll have our regular Monday, Wednesday, and Friday videos coming at you this week and next week. So I see a lot of questions, a lot of comments in here on the chat. We're going to get into that Q&A, but first I want to go into that the stock market right now, my second half strategy, and kind of look at some of the tools that I use when we're looking at stocks. So. The S&P has grown 18% just in this first 6 months, and that is rare. Okay, it's only happened 10 times here in the last I think it's something like the last 70 years. The S&P 500 has rallied more than 15% in the first half. Okay, and the problem though is that it's in the past 7 years, those 10 times when it has rallied over 15%. Guess what it did in the second half? It came down a little bit. Nothing goes up forever. So actually, when you look at the last 10 times that it's rallied more than 15% in the last 70 years, it's come down an average of 12%. With 1 year, the market crash of 87, it was down 34%. So, so that already kind of sets the stage. I don't like to really trade or invest on technical analysis a lot, that past historical, the past historical returns and past historical data, because it really doesn't affect where we're at right now, but it is kind of an ominous sign. So if you look at some things though that are kind of pointing to weakness in the second half, one of the biggest ones right now is just the Federal Reserve. Okay, and are they going to cut rates? Are they going to hike rates? For months, the big overhang on the stock market was the whole trade war, right, and the economy, and that's really where it should be. Okay, the stock market, corporate earnings and corporate profits should rise and fall along with the economy and factors within the economy. Okay, lately here, these last couple of months, it's been all about interest rates. Okay. And that's kind of a warning sign for me, right? When the stock market, when investor sentiment and how much they're paying for stocks hinges on whether the Federal Reserve is going to make rates cheaper, so kind of an artificial stimulus to the economy, that's a bad sign, okay? Because it says that the economy isn't doing well. Okay, if you look past data or historical data, and you look at times when the Federal Reserve is actually cutting rates, okay, then the stock market hasn't done well, even while they're cutting rates, because it is a sign that the economy isn't doing well. So Friday's employment report took a lot of wind out of those hopes for the rate cut, actually, though. And we're going to look at a chart here. This first tool that I look to a lot, or the first website, is the CME. Okay, and they have a tool called the Fed Watch tool. Okay, and this uses all the trading data, on interest rates. Okay, so futures trading data, interest rate trading data, to kind of do a what the market expects rates to be. Okay, so this is showing you. Gotta switch my screens there. This is actually showing you the market expectations for interest rates over. This is actually to December, through the December meeting. So through this year, the stock market, or investors in the market, are expecting. Right here is where we're at, the 225 to 250. That's the current Fed range, right? The current Federal Reserve interest rate range for their Fed funds rate. The market is expecting 43% chance, 44% chance that the Fed is going to cut 2 times, or at least 2 cuts through December, through that December meeting. Okay, and if you look at it, it's actually like at 97%. The market is expecting the Fed to cut this month in July. Okay, if you look at the July data that we have here in the Fed Watch tool. So what does that tell me? Okay, they're expecting 34% chance that the Fed's going to cut 3 times this year. Okay, so now when you think about that, okay, when you think about, like I said, the market is hinging right now on whether the Fed cuts rates or not. The market is expecting the Fed to make money cheaper, to make interest rates cheaper, and really juice that economy. Well, what happens if that doesn't happen? Okay, yes, inflation is low. Okay, so the Federal Reserve has 2 mandates, 2 things that they're supposed to guide its interest rate strategy. Okay, whether it raises rates or drops them. One is employment, right? Maximum employment. Fed wants everybody working. Okay. The other is stable prices, and measured through the inflation rate. Okay. Well, yeah, the inflation rate is under their 2% target. Has been for like the past 10 years basically, but it's creeping up right around there at their target. Okay. So not necessarily something they have to be worried about, but not necessarily extremely low either. Unemployment rate, or employment. We all know that's at multi-decade lows. Okay, unemployment is. Employment is strong. The economy isn't zooming ahead, but it's not doing badly either. So there's no real, unless the Fed is trying to get out in front of something that they see in the future in the economy, then there's no real reason to be cutting rates. Cutting rates maybe as much as the stock market is thinking. Okay, there is no reason to be cutting rates 3 times. Okay, unless we start seeing the economic data come down drastically, unless we start seeing the unemployment picture get dramatically worse, there's no reason for the Fed to cut rates 3 times this year. Okay, but that's what the market is expecting. So what happens if the Fed does disappoint on those rate cuts? Then the market's gonna be in trouble. Okay, and that's what we saw in Friday's unemployment report, where added 225,000 jobs for the month of June, which was a fairly strong number, and that kind of took some of the impetus off of those Fed cuts. People looked at strong hiring and a fairly resilient economy and said, okay, maybe the Fed isn't going to be cutting quite so much, and the market fell by nearly 1% on Friday. Expectations are, and one of those things right now is the interest rates. So, and I pointed out in Friday's video also, it's kind of a warning sign for me over the last month in June, best June since 1938. But if you look at which stocks were rallying, okay, which stocks were doing the best and really leading the market, and it was these rate-sensitive stocks. Okay, you had REITs, you had utilities, and kind of some of those other bond proxies, right? Like consumer staples did really well over the month. So when you look at it, okay, if the economy were strong and investors were positive, then you would think some of these business cycle stocks would be leading, like tech and like industrials and those kind of things. Those should be leading the market higher. They're not though. So when you look at the reason why these rate sensitive stocks are doing so well, it's because of those Federal Reserve rate expectations. And again, not a good sign for the economy that the stocks that are really leading the market are because of a cut might happen. So like we said, like we talked about, the S&P had its best 6 months in years, really. I think since 2016. Best June in decades. And but then you kind of look at the underlying picture, okay? Because so stocks are supposed to be a proxy for corporate earnings, right? That's what you're paying for is that those corporate earnings. And so if you look at the some of the negative guidance, and this is really where we start to see a scary picture for the second half of the year, okay? And this is the sector level negative EPS guidance. Okay, so we're getting into the second quarter earnings reports pretty soon here. So companies are going to be talking about how they did over the second quarter and then giving guidance earlier. And a lot of times companies will guide, before their report, so they don't want to scare investors. They don't want to surprise investors too much during their report. So they'll kind of give a guidance ahead of time. And what we're seeing is the worst guidance in more than a decade. Okay, second highest negative report since 2006. Okay, so of the 113 S&P 500 companies that have issued guidance, that have come out and said, okay, you know what, we're not reporting just yet, but when we do report, it's either going to be more positive than expectations or more negative than expectations. 87 of those companies have issued negative warnings. Okay, and so I don't know how well this graphic is coming through on mobile, but if you look at it here, so this the far left sector on the far left, negative 26 companies of the in the IT space, so information technology. 26 companies have guided negative for that second quarter. The 5-year average is 20. Okay, so well above the negative. The gray lines are a little bit harder to see, but those are the average, the 5-year average for how many companies come out with negative guidance. So each quarter. So next here is consumer discretionary, those apparel names, things like that. 18 companies have guided negative. 16.7 is the average there. Healthcare, 14 companies have guided negative. 10 is the average. So almost all of these, except for consumer staples and financials, are the only sectors where the guidance hasn't been more negative than it is on average. Okay, so this is already a kind of a bad picture, and this is actually from the FactSet earnings insight, and we're going to use another chart of theirs later on in the live stream. But FactSet, and we've talked about the FactSet earnings insight data before on the live streams. Great research tool. I'm actually going to put the name here in the chat. So it's FactSet earnings insight right there. So what FactSet does, it tracks all of the S&P 500 companies for their earnings. It tracks their earnings, the expectations for their earnings. It tracks it by sector. It tracks valuations as far as PE values, that kind of thing. And what you can do, if you Google FactSet earnings insight, okay, Google it anytime, and the first result is going to be the PDF of the most recent update. Okay, they update usually every 2 weeks, every week, every 2 weeks with how earnings are coming out for this next quarter. Okay, so it's a great resource. We'll talk more about that. A couple other things I'm looking for. China and the U.S. are still trying to come through with their negotiating with the trade war. China's kind of taking a hard tack on negotiations, saying that there's going to be no deal unless all the tariffs come out. Of course, the U.S. wants greater protections and monitoring of a lot of this stuff. So, I know the stock market rallied on that G20 news that talks were back on, but really, where are we at from there? Talks are still on. And I think this week is when they're having their first talks in about a month and a half. But they're just talks, and we've been here before. So be cognizant of that. I think those tariffs that are in effect right now, that are still in effect, those are going to start coming through in the economy, and we're going to start seeing those in earnings this quarter and in the third quarter, and especially in the fourth quarter if something isn't done very quickly, especially to those traditional outsourced sectors like apparel and some of those. So now the point here is really that even as the market reaches these new highs, a lot of these underlying fundamentals are not positive. Okay, and the downside risk is probably greater than that upside potential. Okay, we've already seen 18% on the S&P 500 so far this year. it's doubtful that it's going to zoom much higher. Even in the best case scenario, it's probably not going to go so much higher for this year unless earnings really take off, and everything is pointing to a pretty sluggish earnings for this year. We actually might see what's called a technical earnings recession in the third quarter, and that's just two consecutive quarters of earnings decline for companies. Okay, so I think we're expecting 2.6% earnings loss this quarter in the second quarter. For S&P 500 companies, it's a little bit lower expectations for the third quarter, but if you're actually looking at those underlying fundamentals, that earnings growth, and that's what you're paying for when you pay for stocks, is that earnings, then it's not looking great. And if you're within 5 years of retiring, or maybe you have that lower risk tolerance, like we saw in that earlier comment, then you might want to go to more of a conservative portfolio. Okay, 10 years of a bull run in stocks. Hopefully you're doing well. I hope you're doing well, but this is not the time to be chasing returns. Okay, if you're within 5 years of retiring, or you have that lower risk tolerance where a big stock market swing is going to cause you that emotional distress, then I would start looking towards a conservative portfolio, and that just means maybe a little bit more in bonds, maybe a little bit more in real estate, those REITs, maybe a little bit more in cash, just to protect your money. Okay, and we've talked a lot about maybe using that bucket portfolio or that bucket strategy for retirees in the past. We've talked a little bit about that. And even longer term investors, you might still consider like I'm doing, keeping a little bit more in cash and a higher bond allocation. Okay, if nothing else, if you're even younger investors, high risk tolerance, you just want to stay fully invested. Now is the time to rebalance back to your assets. Okay, and what I mean is every investor, whether you're 20 or whether you're 50, you need stocks, you need bonds, and you need real estate in your portfolio. The bonds and the real estate you can just get from those ETFs. Very easy to get a diversified fund of bonds. I use the Vanguard BLV for my bonds. I also use the AGG, which is another very low cost bond fund. Gives you lots of bonds right in that ETF, and it's very low cost. I use the VNQ, which is the Vanguard Real Estate Fund for my REIT fund. I also have a lot of individual REITs. But just go back to how much you have overall in stocks, overall in bonds, and overall in real estate, and make sure that it's a good percentage for each. Okay, most investors, a tragically high amount of investors, have almost all of their money in stocks, right? So when that stock market crash does come, then that's going to be a problem. Now I want to look at a couple more charts and a couple more resources here, just to kind of look at some the sectors within the stock market. So we've looked at kind of the overall picture for the economy, for the market. Now I want to dig a little bit deeper into some of the sectors to kind of get an idea of what's expensive, what might be a good value, and what you might want to be positioning into for the second half. So if you look here, this is actually the SPDR, so SPDR heat map or sector overview. Okay, this tracks all the sectors in the S&P 500, and you can look here. You can get 1 day, 5 day, months, years, 5 years, up to 5 years, as to see kind of relative performance. To see which sectors have really been pushing ahead and which have been coming back. Now, what I want you to do, though, I mean, as you're looking at this, then it's not necessarily where the sectors that have have had the highest returns are necessarily the most expensive either, though. Okay, so like for example, technology, you see is 36% return over the last 6 months. Okay, has beat a lot of these other sectors, but you would expect that. You would expect technology to lead in a growth environment when the economy is doing well. Whereas you would expect utilities to be fairly more modest gains. So it's a lot of it is relative to their performance in the past and relative to where it should be. You would expect technology to lead and utilities to be a little bit lower anyway. So you can't just look at these on an absolute basis all the time. But what we have seen here, especially on that relative basis, is that tech, discretionary, so consumer discretionary, with a 24% return so far in this first 6 months. real estate and industrials has outperformed. But what's interesting is when you do look at the relative performance, so each sector against what it usually does over any 6 months, is that this utilities and the real estate. So we have real estate is 24.6% over 6 months, and that's not normal for real estate. 16.16, almost 16.8% for utilities. That's not normal for utilities. That is much further outside the norm for these two sectors than some of these other ones. So materials 20% return. That's not quite as far outside the norm for materials to do that within 6 months. Healthcare 13%. So you get an idea, like we talked about earlier, that these rate sensitive sectors have really been outperforming. So it might give you kind of an idea of, okay, well, in this next 6 months, especially if the Fed does not cut rates as much as the market expects them to, maybe these rate sensitive sectors will not do quite as well as they have. Okay, and you look at some of the other ones. So energy with an 8.9% return and healthcare with a 13% return have kind of underperformed. So maybe that's an idea of looking within those sectors for relative valuation. Okay, one more chart here, and this one again is going to be from FactSet, and this is the forward valuations. Okay, so forward 12-month PE ratios for each sector, and then the S&P as a whole. Now, okay, so price to earnings ratio is the current price of the stock, or the current aggregate price of the sector, so all the stocks in that sector, over its earnings. Right now, most people you're used to seeing the trailing earnings, so the earnings over the previous 4 quarters. Well, the forward 12-month price to earnings ratio is going to be those expectations for earnings. Okay, so this is the actual current price of the stock sector or of the S&P 500 as a whole, divided by the earnings that the market expects from that sector, from companies in that sector over the next 12 months. I actually kind of wish they would do a trailing earnings, because I'm not a big fan of forward earnings because analysts analysts are very good at estimating earnings for the current quarter, right? But not necessarily out 3 or 4 quarters ahead. If you look at the earnings that we had in 2008, 2009, they were, horrible. And if you look at what the market was expecting before that, they were expecting huge earnings. So that's where we ran into a lot of problems. Stocks didn't necessarily look that expensive when you looked at what the market was expecting for earnings going forward at that point. But obviously we know different now. So that's why I always kind of try to use trailing earnings, so those earnings over the previous 4 quarters instead of what the market is expecting for the coming 4 quarters. But this is what we have from FactSet, and it's still very useful, very interesting chart that they have here. So these are each sector of the S&P 500 plus the S&P 500 itself, the price divided by what the market is expecting the companies in that sector to make over the next four quarters, right, over the next year. And you just see some of these. So the dark blue line is the current forward price to earnings ratio for that sector. The light blue line is the 5-year average forward earnings. Okay, so and then the green line is the 10-year average for that sector. And you can see almost universally here, all except for, what do we got? Industrials, energy, healthcare, and financials. There are these ones on the far right, the four on the far right of the graph here. All the other sectors are more expensive now than their 5-year or 10-year average. Okay, and what's important here to remember is we've just gone through the best 10 years we've had in forever, the longest bull run in history. So this 5-year average and this 10-year average are going to be higher than normal too. If you looked at a 20-year average of price to earnings ratio, they would be lower than this as well. Okay, but because the market has been constantly going higher and valuations have constantly been going higher, these averages are going to be high. So if you look at, for example, the consumer discretionary sector, okay, very far left on the chart here, trading at 21.2 times forward earnings. Okay, that sector, consumer discretionary, is trading at 21 times the earnings that are expected out of those companies over the next 4 quarters. That's kind of high. Okay, especially if you look at the 10-year average of 17 times. So 21. Let's just see how high is 21 divided by 17. That's 23%. Okay, that's a 23% premium over what they've traded at over the last 10 years. Okay, so very high premium there. On a relative basis, it's not necessarily telling you that stocks are going to crash or that they're too expensive or anything like that. You got to use some other analysis for that. But on a relative basis, stocks in the consumer discretionary space are very expensive right now. Okay, and I think that's going to be one of the hardest hit. If the trade deal doesn't come off real fast, or two, I think just when some of the tariffs that we've already had starts coming through in the data. Okay, we've had what 3 or 4 months of this most recent tranche of tariffs that President Trump put on. Those haven't come through on the data yet, but I think a lot of these companies are going to be getting hit on that. The next one here, information technology, trading at 19 times forward price to earnings over a 10-year average of 15 times. Okay, so and looks like that's probably one of the biggest premiums on the chart here. So let's just look at that one. That's 26, almost 27% premium. Okay, so stocks in the IT space are trading 27% more expensive right now than they have been over the last 10 years on average. Okay, so you look at the chart and you start seeing some kind of expense. What's expensive on a sector basis? Obviously, you still might be able to find some good deals in technology. Some individual companies that might be good. But then you start looking on the right here. Healthcare, financials, energy. A lot of these sectors that might be relatively cheaper. Okay, so if you're just looking at sector funds, then you might get an idea of maybe seeking some cover in financials and healthcare, some of those sectors, rather than some of the more expensive sectors, or maybe you start looking at some of these. So again, that's just some of the tools that I use. We've got that Fed rate tool, Fed rate watch from the CME. Really important to see expectations for the market as far as the Fed rate cuts, and then you use your own discretion, your own opinion as whether the market will get that. Okay, I think the Fed will cut one quarter basis point in or 25 basis points in July this month. They are going to cut because I think the Fed the market would just crash if they didn't. Okay, expectations are at 97% that the Fed is going to cut this month. And I think to let that down, the Fed knows that it would just cause havoc. Okay, so the Fed will cut this month, but will they do another 2 cuts over the rest of the year? That's more unlikely. Okay, so we used the Fed rate tool. We used that spider, the S&P. I think this SPI shares the sector. The sector outlook or the sector gains chart, and then FactSet earnings insight. We used that to kind of see the valuations on some of these sectors. So some of the sectors you might want to watch: energy, healthcare might still have some good value in it. Real estate kind of looks dangerous, even though I love real estate. I love using it as kind of a diversifier and safety against stock market weakness, but real estate has done so well over the last month and a half or so that it's going to be a little bit dangerous if those rate cuts disappoint, and then it's a little bit higher valued right now as well. So that's kind of what I'm looking at for the second half of the year. Now I want to get to question and answer. I've seen a lot of questions come through, and I'll scroll up and see what people are asking. But if I don't see your question, if I don't get to your question, please just ask it in the chat again so I can try to get to it. Again, I want to thank everybody for being here. I love doing these every Sunday. I don't get to quite do them every Sunday. Sometimes I have a conflict, but I love, kind of this interaction that we get. Quick question. So SoilWorks 1990. Should I sell off Glad? So Glad I think that's the business development one, right? Or is that, let me check here. I always get Glad confused with Maine, and I know Maine is the business development. Glad is the MLP, right? And I've liked it in the past. I've highlighted it in the past, but I haven't looked at it in a while. Gladstone Capital. So BDC, it's, what are we looking at here? We're 9% yield, and it's really done nothing for, for the last 10 years, other than that yield. And this is something that we've talked about in the past, as far as like especially monthly dividend stocks, high yield dividend stocks, is that you can't just go on that dividend yield. Okay, 9% return on the dividend for the dividend yield is great, and it's not a bad overall return, even if the stock price doesn't go anywhere. But I like to see personally, I like to see my stock prices go up a little bit more, have a little bit more of those capital gains as well. So I would look for companies that have a nice dividend yield, have a high dividend yield, but also are keeping some money back for that growth and for price appreciation. As far as Glad itself, like I said, I've liked it in the past. I haven't looked at it for a while here, but so I don't know exactly what they're doing and why they can't get the stock price to come up. But that's kind of typical for a lot of these very high yield companies. They send all their cash flow back to investors through dividends. They have to raise money a lot through debt. So that makes them very rate sensitive. When rates are coming down, that's fine because they can borrow cheaper. But when rates are going up, then their capital costs become quite a bit higher. What else do we have? Brad, good to see you here. NYC Trading, I have a question about the ETF. VOO, do you recommend ETF? But with some people says you always paying premium prices with ETFs. Okay, so I think your question here is, do I recommend buying ETFs when so basically you have to pay? Oh, that's not it. You have to pay that management expense, I think is what you're asking. I don't know what you're meaning by paying premium prices with an ETF, because ETFs generally, since they're open funds, so whenever a portfolio manager in an ETF gets new investments in, they're creating shares and they're buying those underlying assets. So you're not going to be paying a premium on those underlying assets. Okay, this S&P 500 ETF, the VOO, that's trading, along pretty much, almost a one-on-one correlation going to be with the S&P 500. Okay, that's in comparison with closed-end funds, which I've actually got a video coming up on closed-end funds, and that difference there with the premium and the discount in closed-end funds. Those can rise and fall, mostly on investor sentiment. So not necessarily what I'd recommend there, but just looking at this VOO, and I've talked to people about this before, I don't like S&P 500 funds. Okay, I don't like them because if you look at what you have in those funds, in an S&P 500 whole market index fund, it's mostly going to be technology. It's mostly going to be, I think industrials or materials. One of the two is a very high weighting there. It's basically, three sectors of the economy is like almost 50% of that fund, 50% of the market, and that's just how the S&P is formulated. Okay, it's a market cap index. So these big these big sectors, especially technology, information technology, tend to dominate the fund. Okay, so it's going to be very volatile. Obviously tech is very cyclical, so it's going to rise and fall with the economy pretty harshly. I prefer investing in the in the sectors themselves, in the individual sectors, or maybe a more diversified fund than just an S&P 500 fund. What else? William, is Robinhood a platform for beginners like myself? I like Robinhood. I actually use M1 Finance instead. I use that one for our 2019 dividend portfolio, and just because if I'm investing in dividend stocks, I want to invest them in a retirement account. Okay, retirement accounts. Put your dividend stocks in a retirement account. That means you don't have to pay taxes every single year on those dividends. With Robinhood, there's no retirement account options available. So I have a Robinhood account though, and I do have some stocks in there. I actually have another video coming up comparing Robinhood, M1 Finance, and Acorns. The three big kind of free trading platforms. Kind of comparing them, and it's not so much which one is best, but which one is best for you. Okay, so I mean I love Robinhood's free stock program. It's fun. It makes investing fun, seeing which free stock you get. It's a little bit better for traders and people that want a certain price for a stock, because M1 does daily orders, so it aggregates all your orders. You put in an order to buy a stock at 3 p.m. or 2 p.m., you're not going to get tripped on that. You're not going to get that stock until the next day when that trading order goes through, and that just allows them to to do fractional shares, which aren't available on Robinhood. It allows them to do a lot of other things. So for Robinhood, since you don't have fractional shares, then you're going to need, like, for instance, $2,000 just to buy one share of Amazon if you want to buy Amazon, things like that. So I prefer M1 Finance for some other reasons, but Robinhood is good because you get those instant orders, the limit orders, buy and sell orders that get calculated instantly, so you can get the price you want on those. So I mean, it's free. It's hard to beat free, and I love both platforms, Robinhood and M1, and Acorns as well. If you're more of a set it and forget it kind of robo-advisor kind of investor, but they're good for different people. For the traditional buy and hold, not worrying about trading in and out of stocks kind of investor, I think I would prefer M1 Finance. Just because they're both free, but M1 you get fractional shares, you get really easy rebalancing in your portfolio for free, and so I would go with that one. So Michael wants to stay with dividend stocks next year, so and I probably will have a dividend portfolio at least one. Brad, Mr. Personality, good to see you here. Greg, RE interest rates. What would you look for in examining corporate debts? Where is it? I missed this. I missed. There it is. Okay, examining corporate debt loads and structuring. So, are you talking about obviously you're talking about investing in individual bonds, I guess. Individual corporate bonds and their loads and structuring. I got to be honest with you. I can't tell you. I mean, I've done some bond work, but not that level of deep bond work to really be able to be any help to you. I don't want to give you bad information. Corporate debt loads and structuring, on the equity side, I can tell you that debt is one of the biggest problems for corporations right now. 10 years of super low interest rates. A lot of companies are completely awash in debt, and especially a lot of these companies that have been growing by acquisition, that growth by acquisition model where organic sales growth for their company has been flat. So basically they've just been buying companies. You get a lot of these like Teva, you get GE fell into this problem where their whole growth model, their whole growth strategy is just acquiring other companies. Well, when other companies are expensive, like in a bull market, and they end up paying so much, they put on so much debt, and we're really starting to see the cracks in that. As far as structuring, so I'm assuming you're meaning like like first order liens and where the debt falls within the payment. I mean it's hard to tell you without actually getting into debt analysis, because obviously second order or lower order liens or places in that structure are going to pay more. So really you gotta say you gotta look at what's your opinion on whether this company might default. I mean, if you're investing in that triple C or a single B category where there is a good chance of default, then yeah, that structure of those debts is going to be important, because obviously you want a higher call on those payouts if they default. What else do we have? Didn't reach track with stock market and get clobbered too. Okay, so great question, Susan Goldman, asking, in the housing bubble, how REITs did, and then they get clobbered too. They did, and I think two things there. One is that real estate investment trusts, they invest mostly in commercial real estate. So yeah, even in a normal stock market cycle, even in a normal bear market, REITs are going to come down a little bit. They're not going to have that complete safety like bonds. Because a lot of these commercial properties, they need tenants, and when the economy falls, when people move out of their commercial space, then that's going to hurt. I will say that obviously I think the 2008-2009 crisis was a little bit idiosyncratic or a little bit different than what you're going to usually see in a stock market crash. Obviously that was very much real estate centered. So you saw REITs get hit just as hard as the general stock market. I don't think that's going to be the case. And if you look at other stock market crashes in the past, 2000, the 90s, the early 90s was kind of real estate centered as well. But if you look at a lot of the other times where we had stock market weakness, REITs didn't do as badly as stocks, and it's because you have that diversification. And then when you have a portfolio of the two combined, then you have much more smooth, a much smoother, a much smoother return pattern as well because of that diversification and because REITs generally don't do quite as bad as stocks. These commercial properties, they tend to have 5, 10, 15-year leases on their tenants. So it's much smoother sales, much smoother cash flow on those. Okay, what else? Tara, Golden Boy. See a lot of people here. Thank you for being here again. Okay, Golden Boy is trying to open a traditional IRA account with funds, Vanguard, small cap. Okay, okay. So I mean I don't quite see. I don't see your question. Uh, Oops, and I think I just missed it here. Company's taking on debt. Okay, sorry, I had some problems with the monitoring. Golden Boy, if you want to ask that again. Oh, okay. Trying to open a traditional IRA account with I see your question. Yeah, I like those funds. So VNQ, AMLP, TLT is just government bonds, so it's not going to do a whole lot. That's going to be kind of an extreme safety fund. I think for my bonds, I would prefer maybe the BLV, which is corporate bonds, still a very safe fund, or the AGG, which actually is a lot of corporate bonds, but it also holds a lot of those treasury bonds. So the BLV is corporate bonds, Vanguard fund, so very low expense ratio. Going to be a little bit higher return, higher yield. The AGG is going to be a little bit less risky, but still a decent yield in bonds. So yeah, I would say that's probably a pretty good strategy in those. Probably late to the party is the data from FactSet.com. It's part of the FactSet company. What you can do though, and what I do is just Google search FactSet earnings insight, okay, in Google, and every time it'll be the most recent because they update that earnings insight research. Okay, they put out like a 10-page research note every 2 weeks. Okay, and they update it every 2 weeks. And the first result on Google is going to be that PDF of that earnings insight research. So I just use Google for it because it's going to show you that most updated earnings insight for that. Is there cannabis stock or ETF anyone can recommend? That's a good question. I don't follow cannabis stocks that much, honestly, because I think the future is there for cannabis legalization in a lot of these companies. But right now, and you see this in a lot of these different stocks. You saw this in kind of crowdfunding stocks at one point, but in these stocks where it trades so much on hype and investor sentiment, there's really no fundamentals to look at. Okay, a lot of these companies, it's doubtful whether they'll be around for as long as they need to be to really take advantage of that theme, that long-term theme. But the stock prices are so high just because of that hype, but just because of the potential. Okay, so I kind of put cannabis stocks in that same area as penny stocks. Okay, if you do want to invest in them, fine, that's great. But you really do need to do your analysis, do your research into each individual company, and be ready for those huge, those volatile stock prices because it is all about sentiment. It is all about the hype in those. What do you think about retail stock companies? Also, always thought Nordstrom. Yeah, your retail is tough. Retail, you're going to get a lot of volatility, and there's some good companies there, but the underlying issue has not changed, and they have not been able to out Amazon. Okay, and I don't see that changing anytime soon. So there's some great companies, some very strong retail companies, apparel companies that might provide some good returns, produce some good returns on rebounds and that kind of thing. But I think the overall trend, the long-term trend, is definitely to the downside on a lot of those. So within that theme, I think I would just defer to like a fund, maybe the consumer discretionaries fund, investing in that instead of trying to pick individual winners, that kind of thing. Cannabis. What are the thoughts on AbbVie and planned acquisition of Allergan? Haven't looked at it. Couldn't tell you. I know. Obviously, I think right now is probably a good time to be buying companies to be buying pharmaceutical companies because shares are down over the last year or so. So maybe it's a good acquisition. I can say that before this last year or so, then especially it's the perfect example is Teva. They were on a growth buying, acquisition buying spree, and then they ran into these problems where it's getting hard to cover that debt load and that kind of thing. So right now, looking at acquisitions in the pharmaceutical space, it could be a good idea, could be a good deal. I'd say AbbVie trying to buy Allergan, it would be hard to pass through regulators. I'm thinking there's going to be a lot of changes to those two companies to be able to put them together because they're two huge companies. So I think, I haven't looked at the acquisition itself and the details and stuff, but what happens a lot of times when you get two huge companies that are planning on coming together, the stock prices are kind of dead in the water until they figure out what's going on. Okay, that uncertainty is there, that regulators are going to put a stop to it or at least going to get involved. So you had a lot of what you had with Monsanto and Bayer, what you had with a lot of these others, AT&T and its acquisitions and a lot of those. So there's trying to put together these two huge companies. One, you've got the stock price that may not go anywhere while they're trying to figure this out, which could be upwards of a year or more. And then two, that's a huge task putting two of these companies that size together. So it's really dangerous. It's going to mean a lot of debt probably on the balance sheet. So I'd hesitate. But again, I like AbbVie. Allergan is a good company as well. So I like the two companies separately. Together, it's going to be tough. I don't know. Susan, nearing retirement, 5 to 7 years, reluctant to put money into bonds because with inflation and near to I'll lose money. Thinking about fixed deferred annuity for a bond. It depends on your risk tolerance there, and I applaud you for understanding your risk tolerance and looking at annuities. The thing with annuities is the return is so low. I really don't like annuities because I think you can always do a better return in bonds. Now, as far as inflation eating the bonds, the bond values, I wouldn't be too worried about it. Inflation is nowhere to be seen really. It's been for the last decade. It's been under 2% here in the U.S. and abroad. And I think on that side, the central banks have a lot of room to raise rates to fight that inflation. So I don't necessarily think you have to worry too much about inflation, as long as if your bonds are longer term bonds and things like that. You can always ladder it, so where maybe you have some shorter term bonds that aren't going to get hit by inflation. Go with bond funds, obviously. I think that would be the better decision. I would look towards that bucket strategy that we've talked about in the past. Okay, so you have maybe 18 to 24 months of expenses in kind of money market cash investments. That isn't gonna, it's not gonna go anywhere, but it's gonna be there for you when you need it. Then you have another maybe 3 years in bond investments and bond-like stocks, so utilities and some of those other very safe sectors, and then the rest in a growth portfolio of stocks, and that's gonna give you the ultimate protection for the next year or two. And this is generally when you start withdrawing your money in retirement. This still isn't for your 5 to 7 year retirement window. But it's going to give you the ultimate protection in cash, but still that growth that you're going to need. For 5 to 7 year retirement window, I think I would just shift a little bit more towards bonds, and you can go with some bond-like stuff. Personally, I've got quite a bit of my money in peer-to-peer lending, which are bond-like, but they still give you those higher returns. I do about 9-10% return a year on P2P. Not for everyone, but I think that's a good alternative or a good mix between bonds and stocks. Give you a little bit higher return, but still some safety in there. What else do we have? What other questions? Some feedback on Apple and Babo. Do you think buy this price? I actually have an Apple dividends and Apple stock analysis coming pretty soon, coming within this next 2 weeks. I'm going to be doing that one, so I'm not going to get a lot into Apple. I will say I'm a little worried about about their product cycle. So Apple is with Apple, whenever you're investing in Apple, you have to understand the product cycle. And that doesn't mean that you can't be a long-term investor in Apple, but you have to understand that the stock price is going to rise and fall with that product cycle. You know, when they release those big updates, and how that plays into investor sentiment. Okay, and the product cycle is getting a little mature right now. So I'll be talking about that a lot in the in our stock Apple stock update. Baba, the Alibaba group. I love Alibaba. Valuation seems to have come down a little bit over this last year. Stock really hasn't done a whole lot, but earnings have continued to grow. Baba's a long term for me. You know, I mean that's the e-commerce, that's the Amazon of China, and actually they're growing outside of China as well to be pretty much global e-commerce. So I think Baba is one of those international stocks that everybody should have. It's going to be I think it's going to be good returns. What else? Favorite stocks under $30. I wouldn't look at stocks as far as just their stock price. And we've got a video on the channel about stock prices, how it really doesn't mean anything. Your stock price is just the market cap divided by how many shares is issued. So, a company can have a very high stock price and still be a very good value just because it's a big company with fewer shares. A small, you can have penny stocks that aren't worth anything. But it's just because they have no market cap and lots of shares. So I wouldn't necessarily look at stocks under a certain price or stocks in a certain price range. If you're worried about being able to buy a whole share, like a lot of investing platforms, E-Trade, Robinhood, we talked about, don't have that fractional share. So obviously you have to have $2,000 to buy a share of Amazon, or you have to buy you have to have $173 to buy a share of Alibaba. If you're worried about that, then I would use M1 Finance, which has those fractional shares. I can invest $50 in Alibaba, not buy a whole share, but I've still got maybe a third of a share of Alibaba on that one. Medical bills, student loans I need to pay off. What do you suggest as far as investing for a quick return? That's a very dangerous situation, Peggy. Peggy asks, she has a little experience in investing, but at the moment she has a lot of medical bills and student loans that she needs to pay off quick. What do you suggest for investing for a quick return? That's dangerous, okay? Because I mean, basically you're talking about gambling. You're talking about trying to find a quick return to pay stuff off, and it just doesn't work like that. I mean, if you knew enough about futures trading, then I mean, futures is probably the best kind of real quick return kind of idea. Because you can use so much leverage, but the problem is it can go the other way too. You can just as easily lose all your money, and then where are you at? If it's kind of an emergency situation where you need to pay off these medical bills and student loans, then I would honestly I would look towards a side hustle or some other kind of something else that's going to get you that money fast, rather than stocks. Because any stock where you're expecting to make 15% or more in a year or less, that's risk. There's no reward without risk in the stock market. So you're just as likely to lose a lot of your money as you are to make it there. Best brokers: M1 Finance, Robinhood, and Wealthfront. I mean, like I said, I use a lot of investing platforms. Jose, I use M1 Finance because it's no cost and I can rebalance, with a click of a button. Robinhood's fun. I mean, getting that free stock is fun. It's a fun little thing. Wealthfront, I've looked at it. I don't use it, but I'm not really a robo investor kind of person. But if you want that set it and forget it idea, then that's great. It's great to have a part of your money in robo advisors, so you don't even have to worry about it being there. I use E-Trade for research. I use Bank of America Merrill Lynch for research. A couple other platforms. Ally Invest for an overall financial website, because they offer banking and checking and savings and loans and everything, right? So I have an Ally account for that. So it's really what you need as an investor as far as platforms. What else do we have here? Okay, Mike. Mike asks, any comments on HYG, high yield corporate bonds? So yeah, HYG. I've actually recommended that. I recommend that as part of our, our online or our course, our Investing for Life course, as part of your portfolio. And it's just a great way to get a little bit higher return, but still the safety of bonds. Okay, and so HYZ, it's a ETF of high yield bonds. And what you get with bonds is you get corporate investment grade, so that's the AAA through triple B credit ratings. And these are very solid, very safe companies. But of course, with interest rates next to nothing right now, then you're not making a lot of money. It's that safety play, but you might be making maybe 4% at the most annual return, and that's before inflation. After inflation, it's more like 2%. With high yield bonds, so you come down to a little bit more risky companies, and you get higher return, you get higher dividends and things like that. Now the problem is with high yield bonds. Okay, some people call them junk bonds, high yield bonds, non-investment grade bonds, is that what happens when the economy turns down. These companies that are already in kind of a riskier financial situation, they have more trouble paying off their bonds. So you get more defaults, and that those bonds, bonds, individual bonds might default entirely, so you get no money back. But then even the ETFs, you come down a little bit. If you look at a chart of the HYG, and then maybe the BLV, which is corporate bond fund, and then the S&P 500, then the HYGs, so those high yield bonds, they fall quite a bit as well in a stock market crash. Not quite as much as stocks, obviously. And I like the ETF, the diversified funds that hold thousands of these bonds, because you're not relying on any one individual bond. So yeah, long story short, I like the fund. A little bit riskier here because we're probably in the later stages of the economy. So when the economy does start falling, and if the stock market does come down, if corporations start seeing a little bit more difficulty paying those bonds, and like we said, corporations have been borrowing to the hilt over the last 10 years, then that HYG probably will underperform. But again, I still think it's still a decent safety play, but you do have to be careful. Appreciation fund. Now I have 6 of 7. Talk about Deutsche Bank yet? Didn't talk about Deutsche Bank yet. Actually, I do own some Deutsche Bank. I own Deutsche Bank stock. I have for probably the last last 5-6 months or something. I've been positive on European financials. They haven't worked out real well. I haven't, I see Deutsche Bank, they're trying to restructure. The thing is, if you're investing, especially in, European companies, but especially even the financials there, you got to understand that Europe is much more a protected working class than the U.S. So a lot of times these companies, if they do get into trouble, like Deutsche Bank has, like a lot of the financials there, if they get in trouble, it is very much harder to do those cost-cutting programs, right? To lay off staff, to right-size the company, that kind of thing, because I think it's mandatory for a lot of these companies that they have union representation on the board. So you've got 2 or 3 board members that are fighting against these layoffs at all costs, when it might be in the best interest of the company to cut some of those costs. So it's a tough place for Deutsche Bank. I like the stock just because the valuation, largest, maybe it's the second largest lender in Germany right now, which has always been the growth driver for Europe, economic growth driver. So you got to understand, though, it's like GE. I own GE, but you got to understand it's a very long-term play. Okay, I think the stock will be a good return over 5, maybe even 10 years, but you got to have that time frame because it could be dead money for the next year or two even, until they actually figure out how they're going to turn this around or just sell off the bank, that kind of thing. So what else we got? Challenge. Okay, a couple more questions here. I want to talk. Okay, which company do you recommend for peer lending? I just use Lending Club. Easiest platform to use for peer-to-peer lending. They've got a great automated system. So honestly, I've got about 20,000 in peer-to-peer loans right now with Lending Club, and honestly, it could be a month or more before I even log into the account because I've got it set on that automated strategy of picking loans that meet my criteria. Got a couple of videos on the channel here. You can look for those. It shows you my filter that I use for my own loans to invest in. And I know, the platform is just going to auto invest in loans that meet my criteria, and I don't have to worry about it. So, like I said, I like P2P loans, a little bit riskier than bonds, but a higher return. It actually about 9-10% return last year, 2018, when the stock market was down. So I actually beat the stock market with my P2P portfolio. But there will be a little bit higher defaults when the economy does turn. What else? What else we have here? I want to kind of run through some of these because we're getting a little bit longer on time. Difference between a traditional IRA account and a Roth IRA account. Great question. So you've got two different types of retirement accounts, individual retirement accounts, ones that you control versus like a 401k or some of those things that maybe your boss, your employer set up. Traditional IRA accounts are you get a deduction, so any money you put in that each year is you deduct that from your income. You don't have to pay taxes on it. So excellent, great. But then when you take it out in retirement, it's locked up until 59 and a half years old, right? Anytime after that, you can start taking money out of that account without paying a penalty. But you do have to pay taxes, income taxes, not capital gains taxes or any of that stuff, but income taxes on that amount. Okay, so great to get that instant deduction, but understand that you will have to pay taxes in the future. A Roth, just like an IRA account, but you pay taxes now on it. Okay, so it's regular income. You pay your income taxes, any money you put in there. But when you take it out in retirement, no taxes. And that's no taxes on the money you made, so your returns, or the money you put in, because since you already paid taxes on that anyway. Great way to get tax-free returns. And I actually have a lot of money in my own Roth accounts because of that. Used to be the advice was, you look at your tax percentage right now and then what you think your tax rates are going to be in the future in your retirement, and you kind of make that decision as far as whether you want the deduction now with a traditional IRA or whether you want free tax money, free of taxes in the future with a Roth IRA. I don't like that idea. I like having money in both, okay? Because what that's going to do is in retirement, that's going to give you some tax-free money, and it's going to give you some, some of your deductions now with that traditional IRA. So I say invest in both. You can only invest, it's up to $6,000 a year in both of them. What I do, I invest all of that money, so $6,000 a year in a traditional IRA, right? You get that instant deduction, great. But then every few years, I'll take some of my money out of a traditional IRA. So 3 years I've invested $18,000 in a traditional IRA. Maybe I take $10,000 of that and convert it into a Roth IRA. You pay most platforms, you can do that no fees to convert it. You'll have to pay your income taxes on that $10,000, okay? But then that lets you max out the money that you contribute every year. Plus, you still have lots of money in both accounts. Whatever you want in both accounts. So great strategy to use to give you instant deductions on your income taxes now, but tax-free money in the future. So great question. I'm gonna defer the rest of these questions into the comments. We're getting a little bit long this week. I thank everybody for being here. Again, love these live streams for kind of connecting back and forth with everyone there. If I didn't answer your question or didn't see your question, please, it's gonna take about an hour usually for YouTube to process the video and then put it up on the site. But then, ask your comment in there or your question in the comments. I answer every single comment I get, and I love love the back and forth. So I appreciate it. Like I said, I'm going to be in LA next week for the VidCon conference, so no live stream next week, but I will be back the week after that. And make sure you check out those videos. Thank you.